Today we're talking about Veeva, a leading SaaS business, an exceptional business, arguably at a very full price, however. Look at their historic results, incredible growth rate. You see year after year, not only growth in revenue, but also in non-GAAP operating income. Now, this does add back stock-based compensation, but still, even subtracting that, they are profitable now and historically growing high 20s, low 30s% growth rate, very attractive. And they're saying, hey, we're still even expecting that this year, fiscal 2023, when a lot of companies have been coming under pressure, they're still expecting around 16% growth this year. This is a business that's around 80% subscription revenue. The remainder is services revenue, which is lower margin. That subscription revenue, though, is quite high margin. And it's 50-50 split between customers' commercial solutions, companies that already have, let's say, a commercial product, and customers around 50% around customers that are still in the clinical phase. And we'll talk about that in a second, that have yet to sort of launch a product. And so you see these fantastic results, fantastic fundamentals, fantastic growth rates, fantastic profitability, and yet the stock is down around 50% in just this last year, sort of saying, well, why is that happening? Well, let's take a step back to understand, well, what does Veeva do in the first place? Well, they're the leading customer relationship management software company, so a CRM company, so a SaaS business, built off of Salesforce's infrastructure. So that is important to note. And they also offer other cloud solutions targeting the life sciences industry. So this is very much a niche industry targeting very specific, field, leveraging what Salesforce built, but it's going well beyond the CRM or customer relationship management industry, saying, hey, we're not only going to help you sort of find your customers and make sure you sell and manage your pipeline, but sort of say, hey, there's so much more we can do, for example, around data or analytics or insights, applying machine learning. For example, they've done work with, GSK, GlaxoSmithKline, to help them with the regulatory process, to help them with the clinical process, to sort of say, hey, is this trial going the way you would expect? And that can lead to insights, as you input this data, and needs to be data in a secure setting, as, let's say, trial data gets into one sort of central repository, hey, do you have the algorithm sort of saying, does this make sense? Or are you seeing the progress you want to see? And this goes into a broader comment or a broader press release that Veeva posted, talking about how more than 150 global enterprises and fast-growing companies are advancing clinical trial operations using their solutions. So this is not just customer relationship management. It's offering additional services to those businesses that are trying to launch new drug treatments. You're thinking about the pharmaceuticals, the biotech companies, etc. And so this is managing not only these 150 global companies, but those 150 global companies are working with over 300,000 research sites that are working with more than 1 million patients across many different study phases. So this is becoming a critical tool to manage the data and analyze it to say, hey, should we move along with this trial? Are there, unexpected bumps that can pick up things that, let's say, the physicians, the doctors might not see, or the researchers might not see right away? This accelerates the process and can also accelerate the process of saying this treatment might be working better. And so you see that they're working with 9 of the top 20 pharmaceutical companies, 3 of the top CROs, clinical research organizations, 3 of the 6 top. So they're working with many of the top players, growing. And you look at broadly from what is their suite of business solutions provide, you see this is a very sticky business where for the last 3 years, their revenue retention rate was around 120%, i.e. if they didn't even add any new users, their growth would have been around 20%. So plus adding new users, adding more demand, you are seeing that growth. And you see sort of what their historic functionality is, customer relationship management. Let's say you have a commercial product. Well, are you selling into, let's say, the surgical centers or the hospitals that are relevant to it and tracking that down? Who are the point of contacts? Are you communicating in a secure way? The data and analytics that I already mentioned, making sure the data is stored in a very, secure and a regulatory approved way. Also from an R&D side for the companies that are not yet commercial, but looking to launch a product, hey, how do you make sure you go through the appropriate clinical and regulatory steps to make sure you launch? And they also do have consumer goods, businesses as well, and cosmetics, but that's much smaller percentage of the business. But overall, very sticky business, looking at a very sizable TAM, a total addressable market around $13 billion plus. You can see a sizable amount is around 6 billion is commercial, around 7 billion they're estimating is R&D, tied to these businesses that are doing the clinical process or quality, regulatory, and safety, analyzing, hey, should this product come to market? Is this test done in a safe way? And looking at what they're targeting, currently targeting around 2 billion plus in revenue this year, around 16% growth, targeting 3 billion, by fiscal 2025 or calendar year 25, excuse me. So very shortly expecting, strong growth. But it does make you wonder, well, wait a second. If you're talking about a $13 billion addressable market and you're already expecting to do 3 billion in revenue, let's say in the next couple of years, does that mean your growth rate should be expected to be lower in the future because you're capturing such a big part of the market, unless you're going to expand your TAM or start making some acquisitions? So it is something to be mindful of. Now they are clearly, I'd argue, based on the data, it suggests they have a very, very strong value proposition, potentially unrivaled, when you see that their competitors are growing much slower rates, closer to 7% versus the mid to high teens that you're seeing with, Veeva. VEV is the ticker, VEEV. And so why is the stock down? Well, part of the reason is that they had lower guidance, and they talked about how early stage companies, keep in mind that's the R&D component of their business, fuel a portion of the industry's growth through research and innovation. Tightening of funding for these companies impacts their investment. So you have seen, in this past year, broadly capital tightening, where people sort of say, hey, if this is a speculative venture, I'm not sure I have the money to put into it. Previously, when everyone was rah, speculative ventures, well, you could put money on speculative bets. Maybe it's a lottery ticket, maybe it works out. As that funding sort of pulls out, and you've seen it with a lot of more speculative areas like SPACs and NFTs and things like that. I'm not saying that this is the same, but I'm saying it sort of captures the zeitgeist or the mentality. And so as you've seen that sort of the capital pull, that is going to have an impact on what they're willing to spend on. So they've started to see the effects of these headwinds on their pipeline starting in June 2022. And so they're taking their full year revenue guidance down by about 30 million or about 1.5%. They talk about how a strong US dollar is about half of that impact, and the other half is lower spending from small businesses and extra project scrutiny on some enterprise opportunities. So some larger companies sort of saying, hey, if you want to sign a big deal, you're going to have to run it up to the board. And you're seeing that type of thing play out with a lot of different companies across, around the world with different businesses. I did another video about C3.ai that said pretty much the same thing, where they're having to adjust their go-to-market strategy because of that very risk that larger businesses are going to require more senior approval to sign larger contracts. And so they're saying, well, look, we haven't lowered our 2025 target goal of around 3 billion in revenue. They still think their competitive position and innovation engine is really strong. Their strategic partnerships, with industry is increasing. They view this as an opportunity to consolidate market share, attract top talent. So this is the time for them to do well, but still they will face pressure. And they're also lowering their margins. That is a point that's kind of interesting, saying, hey, yeah, in calendar year 21, we were around 40% non-GAAP operating margin. That is way off from their actual GAAP operating margins because of a sizable amount of stock-based compensation. And so they're saying, yeah, non-GAAP operating margin might be closer to 35% plus because they're making investments either in gross margin or operating expenses, looking at potential products that are lower gross margin, let's say data storage or additional services, as well as making growth investments. So they're making investments now to reaccelerate the business in the years ahead. So I'd argue investors need to see that growth reaccelerate because you are talking about lower profitability. So this lower guidance and lower profitability has translated into a weak start to 2022, where you're looking at operating profits down quarter after quarter, and you're looking at underlying earnings down significantly, earnings per share. And so that is something to note. You're in a period where growth is not what they previously expected, and profitability is not what they expected. Now they still have the profits to reinvest in the business, hire top talent. They make the point that it's easier to hire the top talent in this environment, but it is worth understanding this is going to be a headwind for the stock. Okay, so where does Veeva stock go from here? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. In full disclosure, this is not financial advice. And so looking at it, I think as you consider the valuation and where Veeva stock goes from here, even though it's clearly an exceptional business, high growth, profitability, that's what I like to see, real free cash flows. Looking at this business, if they're talking about a $13 billion TAM and they're targeting, let's say, $3 billion in the next couple of years, that does suggest that it'll be tougher for them to grow at that 30% growth rate in the years ahead. Maybe it's closer to teens. Maybe it's closer to 15 to 20% growth in the years ahead. That's what they're targeting now. Will their new products dramatically reaccelerate the business? I want to see that. Now, another key aspect that might warrant a sizable discount, I'd argue it should warrant a sizable discount, is the fact that their solutions, historically, their multi-channel customer relationship management applications were built off of Salesforce with effectively a contract with Salesforce saying, hey, don't compete with us in this niche, specifically don't try to, come up with a competitive solution. And that agreement goes through September 1st, 2025. My opinion, September 1st, 2025 is, right around the corner when you think about, investing over a multi-year perspective. So that is something to be mindful of. Now, maybe the agreement, renews, but if it doesn't, they do talk about how we would no longer be able to use the Salesforce platform. It would impact their CRM solutions. So, we'll see what happens. That is an overhang. Good chance it renews, but it is something that investors need to be mindful of, seeing that they've leveraged the Salesforce platform. Now, not all of their solutions are built off of, the CRM, Salesforce platform. They have started building their own solutions, and you've seen that push in terms of the R&D side of the business. So that is worth understanding, that they've recognized that as a risk and try to diversify, but it is a core aspect of their business too, even to today, that should be considered when you think about the valuation. Currently around $27 billion market cap. Clearly, the business has done very well, growing 32% 2 years prior, 26% last year. This year, maybe around, high teens, maybe somewhere between 14 and 18% growth. Historically, the company has achieved mid 20% operating profit. Looking at GAAP operating profit, I view stock-based compensation as a real expense. Let's apply a 15% tax rate. It's fluctuated. Sometimes, some years it's, around 20%, some years it's lower, putting around 15%. What's the growth rate in the years ahead? This is the diluted, this is the growth rate that you should consider. Now that's the diluted growth rate. What's it after the additional, the 300 million in stock, the additional 1%, let's say, per year that they're doing in stock-based compensation, that sort of hurts your growth. And so thinking about this on a diluted perspective, thinking 15 to 20%, over the next 4 years beyond the growth this year, if you pencil that out and you assume, let's say, around a 20 times, maybe closer to 30 times earnings multiple, based on those margins, based on that sort of multiple, even throwing in the $3 billion in cash they have on their balance sheet, and it really doesn't pencil out to a great return. I'd argue this is a very unattractive setup, penciling this out. So in order to get a much better result, they're either going to need to start deploying that capital, let's say in a sizable acquisition to accelerate growth, or the investments they're making in operating expenses, their investments they're making in R&D need to accelerate their growth in the coming quarters. Otherwise, their valuation, which I'd argue based on sort of optimized profit of around mid 20% profitability, suggests, they trade around 50, 60 times earnings. The actual earnings multiple is much higher because profit margins this year are going down. But thinking about that, it trades at, low teen sales multiple, forward sales multiple. And I think this is a very rich valuation relative to their current growth rate. And so I think valuation could just be an absolutely huge headwind for Veeva stock in the years ahead. You could easily, I think that the setup is asymmetrically unfavorable to investors with this sort of setup, unless the execution is really exceptional in the quarters ahead, where you see the growth rate reaccelerate. Because if you're in, let's say, an environment of 15% growth, which is great growth, most companies can't deliver that. But if you're in an environment of 15 to 20% growth, let's say over the next 5 years, the stock price is certainly priced for a lot better than that. So you either have, investors just remain, really bullish on the company and keep this lofty valuation. Maybe that works out. Personally, that's not something I would want to bank on. Like I keep looking back to, okay, look at the studies of the 100 baggers, and you will see that there are many times where they can trade at sensible or reasonable valuations, where you could say, hey, company's growing at 25%, and you could buy it at 25 times earnings, that type of thing, or meeting that Peter Lynch rule of, the growth rate to the underlying earnings multiple. And you're nowhere near that here. You're penciling out maybe it reaccelerates to 20%. But once again, that earnings multiple is nowhere near there. And so you compare that to historically, looking at many of those multi-baggers that have done exceptionally well, where there were periods where you could buy at a sensible valuation. I don't think that's here with Veeva. I think Veeva is clearly an exceptional business. That 80%, subscription business, 120% net revenue retention, arguably a very attractive niche industry. But there are some aspects that make me think, okay, what are they going to do next that can result in a more satisfactory return for shareholders? Because I look at that 50% decline and I wonder, why can't that be just the beginning of a decline for something like this? That's independent of Veeva's fundamentals. Keep in mind, you could have 15, 20% growth in the years ahead and still have a weak stock price with Veeva because of how much the valuation is arguably currently baking in terms of their results. If you enjoyed this video talking about Veeva, VEEV stock, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.